In Chapter 16, we're going to take a look at dilutive securities and the effects these securities have on earnings per share, or EPS. Dilutive securities are just financial instruments or any type of security that gives the holder the option to convert the security into common stock at some point. If the holder converts the security into common stock, that means there's going to be more common shares outstanding. And so since common shares outstanding is in the denominator of EPS, the conversion of these securities into common stock could lead to a reduction or a dilution of EPS. So we're going to start by looking at different types of dilutive securities in the first half of the chapter. In the second half of the chapter, we're going to take a look at how these securities affect EPS. So we'll start with convertible bonds. A convertible bond is just like any other bond. It just gives the holder the option to convert the bond into stock. As with any accounting item, there's always certain accounting issues, and one of those is how to account for the issuance of a convertible bond. The issuance of a convertible bond is exactly the same as any other bond, right? There's no separate accounting treatment for each of these at the time. So as we saw in Chapter 14, when you issue a bond, you're going to end up debiting cash for the issue price. And we're going to end up crediting bonds payable for the face value of the bond. Now, the difference between the face value and the issue price of the bond is our discount or premium. In the case that the issue price is less than the face value, we have a discount. So we'll end up debiting discount on bonds payable. If, however, we have a premium, it means the face value is going to be less than the issue price. And so in this case, you end up crediting premium on bonds payable. Again, that part should be reviewed from Chapter 14. At some point through the life of the bond after issuance, someone may convert the bond into stock. When a convertible bond gets converted into stock, two things are happening here. One, we're retiring the bonds, and second, we are issuing stock. Right, so the accounting for conversion is a combination of what we learned in Chapter 14 and Chapter 15, where we covered how to account for the retirement of a bond, and in Chapter 15, we learned how to account for the issuance of a stock. So to retire a bond, we learned that we need to take the accounts associated with the bond off of our books. If we look back at issuance, in the case of a discount, we ended up using two accounts to capture the value of the bonds. The bond payable account captures the face value. The discount captures the difference between face value and issue price. So same thing at conversion. If we have to retire a bond issued at a discount, we're going to end up debiting bonds payable for the face value. And since a discount has a debit balance, we'll end up crediting discount on bonds payable for the unamortized portion of the discount. Right, so that means after issuance, in order to account for the conversion of a bond, we need to amortize the discount up to the date of the conversion. Right, once we've taken the accounts associated with the bonds off of our books, we now have to account for the issuance of the stock. In Chapter 15, we learned that to account for the issuance of a stock, we end up crediting two accounts. One, your common stock account, and your second account is your APIC account. As before, the common stock account is going to capture the par value of the bonds, and the APIC account will capture the excess over par. So if we take a look at this journal entry right here, this is called the book value method because we're recording the common stock at a value equal to the book value of the bonds. So let's take a look at an example. Assume there are $60,000 of bonds issued at a discount by Walmart on January 1st, 2001 for $55,584. Each $1,000 bond is convertible into 50 shares of common stock. So in this case, since the bonds are issued in increments of 1,000 and we have $60,000 bonds in total, that means we have 60 bonds. Since each bond is convertible into 50 shares of common stock, that means 60 times 50, or 3,000 shares of common stock, could be issued if these bonds are converted. To record the issuance of the bonds on January 1st, 2001, as we mentioned, it's the same journal entry we make for regular bonds. So we'll debit cash for the issue price of $55,584. We'll credit bonds payable for the face value of $60,000, and the difference between face value and issue price is $44.16 in this case, which we make a debit to discount on bonds payable. At some point in the future, the bonds are going to be converted. So let's say the bonds are converted on January 1st, 2005, and the stock now sells for $22 per share. It has a par value of 15. As we mentioned earlier, when we account for the conversion of the bonds, we're going to have to take the discount on the bonds off of our books, and we're going to take off the unamortized portion. So since we're not given the unamortized portion in this case, that means we're going to have to amortize the discount from the issue date of January 1st, 2001 out to 2005. To do that, we use the effective interest method as we learned in chapter 14. If we went through that process, we would find that the unamortized discount is $1,100, which brings the book value to $58,900. All right, so to account for the conversion, we're going to take that discount off of our books. Since it has a balance of $1,100, we'll make a credit to discount on bonds payable for $1,100. We'll debit the bonds payable for the face value. So the face value is $60,000, so we have a debit to bonds payable. And then since the book value is equal to $58,900, we're going to record the common stock equal to that amount. Again, we'll make a credit to common stock for the par value. So in this case, we have 3,000 shares that are going to be converted at $15 each. So 3,000 times 15 gets us to 45,000. Now the excess of the 58.9 over the par value of 45,000 goes into your APIC account. So that brings us out to 13,900. Sometimes in order for companies to get bondholders to convert their bonds into common stocks, they need to offer what we call a sweetener. A sweetener is just some sort of incentive given to bondholders to get them to convert. So it could be cash, it could be common stock, or other types of assets. To account for the sweetener, we're just going to record it as an expense, and we'll measure the expense at the fair value of the consideration given. See how this works? Let's just assume there's $500,000 of par value bonds, and they're convertible into 100,000 shares of $2 par value common stock. Walmart offers an additional $50,000 cash to bondholders for our conversion. All right, so assuming conversion's actually made, what's happening here is we're offering $50,000 of cash as a sweetener. So we'll recognize a debt conversion expense. And since we're paying cash of $50,000, we'll credit cash for $50,000. Right, the other part of this journal entry is just to record the conversion. Again, these are $500 par value bonds. So we'll debit bonds payable for $500,000 to take it off of our books. And in this case, since the bonds are at par, we'll record the common stock at equal to the book value of the bonds of $500,000. So again, we'll credit common stock for the par value of $2 per share. Since there's 100,000 shares, that means common stock is credited for 200,000, and the excess of the 500,000 over the 200 goes into our APAC account. So that pretty much sums up the accounting for convertible bonds. The next topic is accounting for convertible preferred stock. Convertible preferred stock is just like regular preferred stock, except now the holder has the option to convert it into common stock. The accounting for convertible preferred stock is very similar to convertible bonds. At issuance, we're going to record convertible preferred stock similarly to regular preferred stock. So before we saw at issuance, we're going to debit cash for the issue price, and then we're going to record the value of the preferred stock into two accounts. The preferred stock account captures the par value, and the APIC account captures the excess of the issue price over par. When a preferred stockholder converts into common stock, so at conversion, pretty much two things are happening. We're retiring the preferred stock, and we are issuing common stock. To capture the retirement of the preferred stock, we just need to take the preferred stock accounts off of our books. As we saw, we used two accounts to record these. They're both credit balanced. So to take it off of our books, we're going to debit these accounts. We'll debit preferred stock for the par value, and we'll debit APIC preferred stock for excess over par. The second part of this is to record the issuance of the common stock. Again, you use two accounts to record issuances, the capital stock account and your APIC account. Again, the capital stock account captures the par value, and your APIC captures excess over par. So this will generally be the journal entry you're making for conversion of preferred stock. In some cases, however, the par value of the common stock is going to be greater than the book value of the preferred stock. In this case, this journal entry here is no longer going to work because the debits won't equal the credits. So in the case that par value of the common stock is greater than the book value, we're going to make a different journal entry. To see that entry, we'll just use this example down here. So let's say Walmart stockholders are converting 100 shares of preferred stock of par value of $1 that was issued at $2 per share for 100 shares of common stock with a par value of $3. So again, we're going to take, at conversion, the 100 shares of preferred stock off of our books. So we'll debit preferred stock for the par value. There's 100 shares at $1 a piece for a total of 100. The APIC account is also going to have a balance of 100 since the issue price was 200. So we'll debit APIC for 100. As we mentioned, you're going to issue the common stock at par. 100 shares of common stock are being issued, so we'll credit common stock for 300. At this point, the book value of the preferred stock is 200. We're trying to record the common stock equal to the book value of the preferred stock, but the preferred stock's just not worth enough. So at this point, if we want our debits to equal our credits, we're going to have to debit some type of equity account in order to keep the accounting equation in a balance. And in this case, the debit is going to be to retained earnings. So the next topic is going to be stock warrants or stock options. Again, we're going to account for how to account for the issuance and then for the exercise of the warrants. So a stock warrant is just a certificate that gives whoever's holding it the option to buy some shares of common stock in the future at some price. When the warrants are issued by themselves, no journal entry is going to be made. However, if the warrant is issued with another security, such as a bond or preferred stock, in that case, we consider the warrant and the other security as two separate securities. To split the issue price between the warrant and the stock or bond, we're going to end up using one of two methods. This method is very similar to what we did with lump sum issuances of common stock and preferred stock in a previous chapter. And that is, if we know the fair value of both the warrant and the stock or bond without the warrant, we use what we call the proportional method. So we'll allocate the issue price based on the proportional fair value of each item. If we know the fair value of only one of the securities, then we use the incremental method. So that means we'll allocate the issue price to the item that we know its fair value first, and then we'll issue the remainder to the other security. See how these work? Let's use an example. So first we'll look at the proportional method. Let's assume Smith & Wesson issued $1 million in 10% bonds with detachable warrants at par on January 1st, 2001. Each $1,000 bond was accompanied by one warrant, allowing the holder to buy one share of common stock. Now assume that the market price of the warrants is 30 and that each bond without the warrant sells for 99. So in this case, we know the market price of the warrants is 30 and we know the market price of the bonds because these sell for 99. Right, since we know the market value of both items, we're going to use the proportional method. So first step is going to be able to determine the total fair value. Since the bonds sell for 99, that means 99% of face value. Fair value of the bonds is 990. There's 1,000 warrants in total. And since the market price of each warrant is $30, that means fair value of the warrants is 30,000. So if we add together the 990 and the 30, we get to 1,020,000. Right, again, we're going to use the proportional fair value to allocate the issue price. So for the bonds, we'll take the $1 million, we'll multiply by the fair value of the bonds over the total fair value of 1,020,000. That'll get us up to 970,588. Same thing for the warrants. We'll take the issue price, multiply by its proportional fair value of 30 over 1020. That gets us out to a value of 29,412. To make the journal entry, think about what's happening here. We are issuing bonds with attached warrants for a total issue price of $1 million. So we're going to debit cash for $1 million. Second, we need to record the bonds, and we're going to record the bonds at 970,588. Again, we'll make a credit to bonds payable for the face value. The face value was $1 million. And then the difference between the issue price of $1 million and the amount allocated to it is going to be your discount or your premium. In this case, we're allocating less than $1 million of face value to the bonds. So the difference between $1 million and the 970,588 will be our discount of 29,412. Right, so we've recorded the bond. We also need to record the warrant. The warrant was issued at 29,412, so we'll credit paid in capital on the stock warrants for that amount. Now let's go through an example with the incremental method. So Smith & Wesson Corporation issued $60,000 of 10% bonds with attachable warrants on January 1st, 2001 for a total of $65,000 cash. Each $1,000 bond was accompanied by 10 warrants, allowing the holder to buy one share of common stock, par value of $5 for $30 a share. The warrants had an immediate market value of $4 each. So in this case, we know the fair value of the warrants, but we don't know the fair value of the bonds without the warrant. So in this case, we have to use the incremental method. The bonds are being issued for $65,000 cash. So if we wanted to journalize this, we know we need to debit cash for $65,000. Right, the issue becomes, how do we allocate the $65,000 in cash between the bonds and the warrants? Since we're using the incremental method, we're going to allocate the $65,000 first to the warrants because we know its fair value. So we know we have $60,000 in bonds total, and each bond is worth $1,000, so we have 60 bonds. Each bond is accompanied by 10 warrants. So 60 bonds times 10 warrants each equals 600 warrants total. Each warrant is worth $4 each. So we're going to record warrants of a total of 2,400. So we're going to credit PIC warrants for $2,400. Again, the remainder of the issue price of $65,000 minus the $2,400 we've already allocated is going to get allocated into the bond account. So a total of $62,600 will be allocated to our bonds. To record the bond, again, we'll credit bonds payable for the face value. So in this case, face value is $60,000. And then since we're allocating a total of $62,600 to the bond, the extra $2,600 is going to go into a premium account. Let's continue on with this example to see how we account for the exercise of stock warrants. So now let's assume that 20% of the stock warrants are exercised on January 1st, 2002. Again, we had 60 bonds. Each bond was accompanied by 10 warrants, so we have 600 warrants outstanding. If 20% of these are exercised, that means 120 warrants are exercised. As stated on the previous slide, each warrant allows the holder to buy 1 share of common stock. So if these 120 warrants are exercised, 120 shares are going to be issued. The shares are going to be purchased at $30 per share, as stated on the warrant. So the amount of cash the company is going to get is the 120 shares times the exercise price of $30 for $3,600. And then finally, since the warrants are going to be exercised, they're going to be expired. So we need to take those warrants off of our books. They're originally recorded at $4 per share, so $480 of stock warrants need to come off of our books. All right, so if we understand what's happening here, we can then make the journal entry. So the holder of the warrants are exercising these warrants. They're going to give us cash in exchange for common stock. Right, so we can debit cash for the amount we received of $3,600. Second, since the stock warrants are expiring and we originally recorded the issuance of stock warrants with a credit, we need to debit the stock warrants for the book value of $480. So we'll debit paid in capital of the stock warrants for $480. Lastly, we need to record the common stock or the issuance of the common stock. Again, we'll record the common stock into 2 accounts, your common stock account and your APIC account. The amount we're going to record it for is going to be equal to the fair value of the consideration given. So we gave up $3,600 in cash and we gave up stock warrants worth $480. All right, so in total, that comes out to a total of $40.80, and we'll record $40.80 into our common stock accounts. Again, the common stock account captures the par value. The par value here is $5 a piece. So 5 times 120 gets us to the 600. And then the excess of the 480 over the 600 goes into your APIC account here for $34.80. The next dilutive security, or type of dilutive security, we'll cover is stock-based compensation. Stock-based compensation just means to pay our employees for the work they're doing. We're going to give them some form of stock instead of cash. The basic idea behind this is that if we give our employees and managers stock, they now have an interest in increasing the stock price. So in other words, they have interests to work in the best interest of shareholders. Usually for most mid-size and large companies, share-based compensation is going to be massive compared to other forms of compensation. So for example, if we look at Microsoft, this is taken from the 2015 proxy statement. And if we just look at, for example, the CEO, Satya Nadella, his stock awards in 2014 were close to $80 million, and in total, his compensation was a bit over $84 million. Right? So in total, his stock-based compensation was close to 95% of his total compensation. To account for stock-based compensation, first, there's different types of stock-based compensation. Usually it'd be some form of stock options or a restricted stock. No matter what type of stock-based compensation it is, the accounting for it is going to be pretty similar. So first, we're going to determine the fair value of the compensation on the grant date. And then after that, we're just going to split that fair value evenly over the service period. And so accounting for stock options, again, a stock option just means that whoever holds the option can buy some number of common stock in the future at some price. Whenever we deal with stock options, there's 4 important dates. The first is the grant date, which is just the date that the stock options are awarded to someone. Before the employee can actually exercise those options to buy stock, generally some amount of period must pass before they can do so. This is known as the vesting period. So over the vesting period, there's different requirements for different companies, but generally it just means the company needs to work for the company for a certain number of years before they can exercise the option. After the vesting period's over, the employee can actually go exercise the options. So here, over the exercise period, they can buy the shares at whatever price is specified in the option. And then at some point, the employee's ability to exercise the options expires, and that date would be the expiration date. As I said earlier, to account for stock options, we're going to figure out the fair value as of the grant date. We're going to then take that fair value, recognize it as stock-based compensation expense over the vesting period. We're also going to make journal entries for how to account for when our stockholders actually exercise these stock options. And then finally, how do we account for stock options if they expire? So to account for stock options as of the grant date, there's been 2 different approaches used in the past. I'm not going to go into the details of that. Rather, current GAAP requires us to use what we call the fair value method. Right, so fair value method just means we're going to determine compensation expense based on the fair value of the options that we expect to actually vest. If the value of the stock or the stock option changes in the future, we just kind of ignore that and we just use our initial estimate. And we're going to, again, allocate that initial fair value estimate over the service period. For this class, the service period is always going to be equal to the vesting period. To actually get out to the fair value of the stock options, we use pretty sophisticated pricing models. If you've heard of Black-Scholes or a double lattice model, generally they're referring to a model used to determine the fair value of stock options. Again, we're not going to get into the details of that in this class, so you'll be given what the fair value of the stock option is. To see how the accounting works, let's just take a look at an example. So Dane Corporation grants $50,000 in stock options to its employees on January 1st, 2011. The options vest on December 31st, 2013, and grant each holder the opportunity to buy 1 share of Dane's $2 common stock for $30 per share. The options expire on December 31st, 2019, and Dane stock currently sells for $31 per share. The fair value option pricing model values the options at $300,000 or $6 per option. On January 1st, 2011, fair value is $750 per option on December 31st, 2011. All right, so again, first step for accounting for stock options, let's figure out the market value on the grant date. In this case, or in most cases for this class, that'll be given to you, so market value is $300,000. Again, we said we'll take that $300,000, we're going to split it over the service period. For this class, it'll be your vesting period. All right, so the vesting period here is from 2011 to 2013. So to journalize what's happening here, we said earlier that if stock options were issued by themselves, we're not going to make a journal entry for it. It's the same thing here. These stock options are being issued out to employees without any other types of stock. So we're not going to record anything as of the grant date. However, we did say that we'll take the market value of the grant date of $300,000 and we're going to split it evenly over the vesting period over 3 years. So $300,000 split evenly over 3 years is just $100,000 each year. So each year we're going to recognize compensation expense of $100,000 because we're compensating them with stock. And then ultimately to record the value of the stock options. Each year we'll credit paid in capital stock options for the $100,000. Again, this will be our journal entry at the end of each year of the vesting period from 2011 to 2013. So that covers the journal entries for the grant date and for the vesting period. After the vesting period is over, the employees can now exercise the stock options. So let's assume that $5,000 of the Dane Corporation stock options, or 10%, are exercised on March 15th, 2015. The stock is selling for $38 per share. This results in the issue of 5,000 shares of stock. All right, so if we go to, or if the employees go to exercise the stock, right, they have to pay us the exercise price. So since 5,000 options are being exercised, each option allows them to purchase 1 share, and it's at a $30 exercise price. That means in total we're getting $150,000 in cash. So we'll debit cash for $150,000. Second, when the employee goes to exercise the stock option, we need to take those stock options off of our books. We originally recorded the stock options at a fair value of $6 a piece. 5,000 options are being exercised, so we're taking $30,000 of stock options off of our books. So we'll debit PIC stock options. The final part of this is that the employees exercise the stock options to get common stock. So we're going to make credits here to common stock and APIC to capture the issuance of the stock. The amount of value of that common stock is going to be set equal to what we gave up. So we gave up, or the employees gave up $150 in cash and $30 in stock options. So we'll record the common stock at a value of $180 total. So we'll credit common stock again for par value. Par value is just $2 a piece. There's 5,000 shares, so $10,000 total. And the other remainder of the $170 goes into your APIC account. Let's continue on with the same example, and let's just say the company only exercises these 5,000 options. Right, so after the exercise period's over, eventually those stock options are going to expire. When stock options expire, we need to remove the stock option account from our books. So we'll close out the PIC stock option account, and then to make our debits equal our credits, we'll just credit a PIC expired stock options account. All right, so let's just assume that Dane Corporation's remaining 45,000 outstanding options expire on December 31st, 2019. So if you recall, we recorded those 45 or the stock options at a fair value of $6 a piece. So if we need to take the stock options off of our books, we'll debit PIC stock options for 45,000 times $6 or $270. And then, as I said, we'll just record that into our expired stock options account. So we'll credit PIC expired stock options. The last thing we need to cover with respect to stock options is how to account for forfeitures. Earlier we mentioned that in order for an employee to exercise his or her stock options, they need to meet certain vesting requirements. If these requirements aren't met, that just means the employees forfeits the stock options and they no longer have the right to buy the stock at some specified price in the future. There's two methods to account for forfeitures. The first is to just account for the forfeitures when they are incurred. This is the method we're going to be using for this class. There is a second method that's acceptable under GAAP that's not covered in our textbooks, which is called the CASO textbook, and that is to estimate the percent of forfeitures. You don't need to know this method for this class, but if you do plan on taking the CPA exam, it is something relevant that you should know. So I've put it in the slides just so that you are aware of it. To learn how to account for forfeitures, let's just use an example. So let's say there's 3,000 stock options. They're granted to employees with an exercise price of $10 per share. These options vest in 3 years, and the fair value of each option on the grant date is expected to be $12 per option. So just to review here, on the grant date, we're going to determine the fair value of the stock options. So the grant date, the fair value is simply equal to the $3,000 or the 3,000 stock options, and they have a fair value of $12 per option on the grant date. So that gets us out to $36,000. On the grant date, though, we're not going to make any entry. Rather, we're just going to take that fair value of the grant date. We're going to recognize it as an expense over the vesting period. So in this case, the options vest in 3 years. So if we take 36,000 and divide by 3, we get out to 12,000 per year. Right, so over the next 3 years, we're going to recognize compensation expense of 12,000 per year. So we'll debit compensation expense, and the compensation expense reflects the issuance of stock options of 12,000 each year. So we'll credit PIC stock options for 12,000. Right, so year 1 and year 2, we would make this journal entry. Now let's assume that 5% of the stock options are forfeited at the end of year 2. Right, so earlier we determined the fair value of the stock options is $36,000. Now if 5% are forfeited, only 95% of that should be considered an expense, or $34,200 in total. If we take that $34,200 in total and we divide it over the 3 years, that means our real compensation expense should only be $11,400 per year. Since we've already recognized compensation expense for the 2 years, that means the total compensation expense recognized is the 12,000 times 2, or 24,000. And the same thing for our PIC stock options, we'd have a balance of 24,000. So our total. All right. However, we just said that we should have only recognized $11,400 in each of the 2 years. So our true compensation expense is $11,400 times 2, or 22,800. And our true balance in PIC stock options should be also 22,800. So in other words, we just need to bring compensation down from 24,000 to 22,800. Same thing for the balance in your stock options. Since compensation expense normally has a debit balance, we'll make a credit for the difference here of $1,200 to compensation expense, and then to bring our balance of PIC stock options down by the $1,200 difference here, we'll also make a debit to PIC stock options for $1,200.